Hey guys, we're doing our housing market update. Hope everybody had a great week so far and have a great weekend as we go head into the weekend. I'm going to jump right into some information here that I think you're going to find useful. And basically, some of what we've already talked about, but looking at what the Fed has said over the last couple of weeks, um, we're seeing that uh someone asked me, well, Chris, you mentioned the construction stuff, and why haven't we started to see the drop in construction workers, which tells us that we're heading into a recession, which I've talked about before. We've got to see that. We've got to see that unemployment number tick up according to the Fed. Okay, not that we're rooting for that, but that's what the Fed wants, because they're trying to tame inflation. Again, I've already talked about all the other factors that could do that without, with improving the economy. But that aside, that's what they're looking for. I think that they're kind of caught off guard that it hasn't happened yet, to be quite honest. But the construction workers are going to be the key. The construction worker taking a hit is usually the first sign of a recession and a cycle where we're going to see things slow down. So, we had the apartment boom, and then we had a backlog in new homes. So that takes about 21 months, right? Time it takes for those projects to get done, pretty much on average. So whether it be new home or those apartment complexes, things like that. Um, so there's a backlog in these two sectors, of the residential market, and even the multifamily. So we've seen an uptick in people also fixing their homes, okay, to put up for rent and things like that. There's been a big surge in that too, which is smart for people to be getting involved in that to get that cash flow going. Great way to invest your money. Um, so with that, we've seen construction worker numbers growing. So it's like, what's going on? And for multifamily and single family, they are dropping inventory at right now they're at about 98,000 inventory. So it isn't a lot when you look at single family, multifamily, and the builders again are not the march of dimes. So permits are down, even though construction employment's up. For now, we're seeing those permits drop, and so single family and if single family and multi-family continues to drop the permits, as we've seen over the past couple months, we're going to see the beginning of that recession. As always, in every recession, construction drops off. Okay, construction workers drop off, and that unemployment has a ripple effect throughout the economy, and we have the Fed then, uh, with this idea of them saying rate cuts will be on the horizon. We don't see any reason to raise rates. Um, Many of them are talking about this maybe happening later in the year. Some have said September, some have said December. We'll have to wait and see. But these frontline data numbers tell the tale, okay, on this construction stuff and these permits and all that. So when we see again 323,000 is the number for the 4 week moving average, there's a recession coming. Okay, that's when they're going to be getting off that marker. So we want to see the Fed's rate come down. That is an indirect correlation with the mortgage rates because it works with the bond market. So we saw that today with permits at basically COVID uh, 19 recession lows, and disinflation of apartments has gone away and it's beginning to tick back up again as far as that inflation rate. So you need lower rates to grow sales over a sustained period of time. So if we continue on this path, we could see the beginning of all this happening really soon. So I think they're really surprised it hasn't happened yet to a larger extent. They're hoping also that the 10-year yield does a lot of the heavy lifting for them, as far as the Fed is concerned. And the labor data is again at pre-COVID status. So, you know, all those other jobs that come back and all that sort of thing that we had lost during that. So, you know, on the inventory, as far as inventory goes across the country, year over year, we're at 620,000 this week, and inventory growth is big, but mostly Texas and Florida. So when you hear those numbers, take that into context. We thought we would be at 800,000, but you know, the best of the last 3 years is right, you know, right now. So better than 2022 was at 240,000 when all this kind of started, right? We saw the inflation rate go up, and we saw all the problems start, you know, back in 2022. So for Phoenix, 2014, we had the same numbers as today in a balanced market. Okay, according to the Cromford Market Index, and what Cromford has to say about all this, we have 52% more in inventory than this time last year, and that means you know, we've got to absorb that, right? And we're seeing our demand is also 5% lower than last year. Okay. I think people really were counting on these rates dropping. I think a lot of people have gotten used to it, but I think more so people are waiting, you know, for those rates to drop. They're waiting to see what happens and all that. Again, do the opposite of what the majority of the others are doing, as Warren Buffett puts it. And that's when you will get ahead. Okay. Usually, most people don't, you know, capitalize when these things happen. And, you know, what I mean is right now, if you can't afford it, you can't afford it. But if you've got to move, want to invest, now is the time you can get not only reduction in pricing, okay, because of the weak demand and the higher rates and all that causing all this, and a surge in inventory, but you know, we're you know we're also able to get lower rates, buy down concessions from sellers. Okay, so keep that in mind. I mean, builders are spending a fortune on buy down rates, down payment assistance programs. Same for resale, you know. So it is a good time to be a buyer from that standpoint. I know everything costs more, housing costs more. It's very expensive to do anything today, but you want to buy when things are slow. You don't want to be out there when everybody else is out there going after the stuff, okay? Because the prices are going to drive up. You're going to be banging your head against the wall, and we're going to be back into some of that crazy market stuff again. So, we have 82. Let's see. Well, I'll get into this in a second. So, let me just share my screen with you here in a minute, for a minute here, and I want to show you some of this other stuff going on. Whoops, kind of jumped ahead there on you. Okay, so inflation slows in May with consumer prices up 3.3% from a year ago. You know, we're seeing a little bit better. Remember, they track PCE. A lot of these articles, a lot of time, will talk about CPI. But they are still not hitting that 2% target point. So it slows, but it's not where they want it to be. Again, they could fix it pretty quickly if they made some changes in policies, but they're not going to do that as far as all the out of control spending and all that stuff. The Fed Kashari, the head of the Minnesota Fed, I'm sorry, Minneapolis Reserve Bank there, president of the Federal Reserve Bank in Minneapolis, you know, has said some of these things. I'm optimistic that fundamentals of the economy are very strong. There's some evidence of some softening around the edges of the economy. We're getting disinflation despite remarkable economic growth. The interest rate outlook depends on the path of economic wage growth might still be a bit too high. I will probably take a year or two to get inflation back to 2%. A year or two, guys. So these rates, I put out these videos before. When you look at decades, number one, we have been spoiled to death as far as interest rates are concerned. This out of control spending and the interest rates could be tamed. But historically speaking, the economy, um, has changed over the years, and we've seen these factors that we're dealing with now with high energy prices and all that. So a lot of these different factors, supply issues. So a lot of this stuff is just hurting us. And if you want lower prices, you need more supply. You need better supply of lumber. You need better supply of windows, all the things that go into buying a house, right? Or building a house. And you need lower rates over a sustained period of time for the builders to ramp things up because they're not going to over ramp it like they did during the crash. Okay. It's not going to happen. So there's no cavalry coming. Things have just slowed down to a normal balanced market, though, with historically average interest rates. It's just the way it is. So we can debate if the economy's also been run poorly over the past 20, 30, 40 years, for the most part by many of our leaders and overprinting money and going off the gold standard and all those things that we want to talk about. But we are where we are. And, here's one other heading. Home sales fell to one of the lowest levels on record in May. Okay. Home sales, not home prices, home sales. Let's make sure we're not, losing it here. But there have been only 2 months in the past decades with fewer home sales, high home prices, elevated mortgage rates, ongoing, shortage, housing shortage are deterring buyers. The median U.S. Home sale price hit a record high in May as demand continued to outpace supply, with a number of sale roughly 25% below pre-pandemic levels. Still, about 1 in 5 sellers cut their list price as homes in many areas are sitting on the market. Okay. And we see also 3 in 5 home listings are now stale as record high costs dampen. Okay. So more than 3 in 5, okay, 61.9% of homes that were on the market in May had been listed for at least 30 days without going under contract. That's up 60% 1 year earlier and roughly 50% 2 years earlier. Okay. So, it's really, kind of a trend across the country, and it's no different here. I shared this with you a few weeks back or a couple weeks back. Home prices could start dropping this summer, marking the first domino to fall on the way to weaker economy, strategists said. So, but remember, when the economy weakens, what happens? We actually get better rates. Okay. I know we're not rooting for a weak economy and people losing their jobs, but for the housing market, okay, that's what'll happen. So um, a couple other numbers here to kind of let you know about is 88,228 homes under contract for the 23rd week of 2024. That is the lowest number under contract in the Phoenix area, in Phoenix, since 2007. Oh, Chris, that was the crash. Yes. Okay. That's just one statistic, though. So we don't want to take it out of context and lose our minds. But it does show a weak number. Now, again, these rates have been high for a couple of years now. According to the Fed, they may be high for a couple more years. Um, so we've got to keep in mind that these things take years sometimes to correct themselves. A lot of it has to do with, economic policy and all that for sure. But right, wrong, good or bad, that's just the way it usually goes. Even if, the best economist and, person in the world took over the economy tomorrow, it's going to take a while to kind of right this ship. Okay. So, um, you know, the idea that in some of the past videos I put out, some of these interest rates, when you go back and look at them throughout history, for 1 decade may hover around 6% or 7.5%, depending on which decade you're looking at. So, better to buy when things are slower or in a balanced market, get a better deal on it, get a, maybe, yeah, price reduction, but more importantly, a rate reduction, right? So, um, the same week in 2011, for context, there were 21,000 in the Phoenix area, 21,000 homes under contract. Okay. So this under contract tells us how many buyers are in the market, how much activity, how much demand is happening. So we had a little over 8,000, okay, this week, okay, lowest number since 2007, and 21,000 back in 2011, okay. So very slow market right now, very slow market. The market conditions are not the same overall with inventory and all that sort of thing as they were in 2007. But that is similar due to rates. Okay. Um, so housing permits and starts drift lower. That's only going to put more pressure on supply. Okay. That means, demand, um, demand is uh, not doing great either, but excuse me, but without more supply, prices are not going to stabilize, prices are not going to stay low. Now, there may be a lot of price reductions going on, but overall, people are way, way, way ahead from where they were, just 3 and 4 years ago, obviously on equity gains. Okay. Due to the crazy market we had. Mortgage rates unchanged versus Tuesday's levels. Over the past couple of weeks, though, again, we've just seen this kind of hovering around 7%. It goes down a little bit below, a little bit above, right there, right around 7. So it just kind of hovers. Again, the splits between the 10-year yield and where the mortgage rates are getting better. They've gotten better. The 10-year has gone up a little bit. As of today. But here are our mortgage rates right now as far as the overall averages across the country. Now, again, I just made a video with our preferred lender, our mortgage broker who shops the best rates, does not overcharge with fees and stuff. They shop the wholesale rates. I just did a video with Evan Einhorn over at Modern Home Lending. He went through everything as far as some ideas on how we can help you and provide some value in getting you an affordable rate today, whether it be assuming somebody else's low rate mortgage from the past few years, or however many years they've had that lower rate in the twos or threes. We have ways of searching for that, targeting that, and we can put offers in on those properties, get the approval, and then you're there with a 2-3% mortgage rate, on those properties. Good deal. Also, there are the rate buy downs, which a lot of sellers are having to cover right now, and it's a way of marketing your property for sale, where we can offer, the idea of getting someone a buy down rate right now. Going to make a much bigger difference and impact on your mortgage payment every month than getting a lower cost, the lower overall price on a home. Just throwing out there round numbers, on a $500,000 house, you drop $10,000, may save $78. You get a rate buy down, you're talking hundreds of dollars. Okay. So big difference on your monthly payment. And if you're like, yeah, but I want to pay the thing off faster and all that. Yeah, but now you've got more money to do that. You can take that extra money and do that if you want to, or put it towards other investments or other things. So these rates are usually going to run about 50. I've even seen as high as 100 basis points, depending on the type of loan and everything, with our preferred lender, who's a mortgage broker shopping the best rates. 9 out of 10 Americans agree May was a bad month to buy. Okay. But again, it's challenging with the cost of everything going up. People have less resources right now. Prices are still up there, and you've got these mortgage rates that just won't go down because they keep spending out of control printing of money by the government. Number one, and all the other economic factors that go into that. So we see that that's the sentiment right now, though, right, wrong, good or bad, whether you agree with it or not. That's just where we are. People, the market has gone to a balanced market. Right now, we've got a little over 18,000 in all property types active in the Phoenix area. And the Cromford Market Index puts us at 104. Between 90 and 110 is a balanced range, 100 being completely balanced. We are in a balanced market. We're in a normal market. Things take longer to sell in a normal market. Um, check out this week's closed days on market. I think we're at about 30 median days. Um, and we're at 58 median, but the closed average actually closed out, not to get under contract, but closed this week was 100, provided by our broker. The month supply 3.57. We usually like to see that 2.5 to about 3 month supply for a more brisk market, but yet more in a balance range. You hear all these numbers about balance, okay? Before the internet, the idea was about 5 to 7 months. Now, the idea you hear a lot is 4 to 6 months. For Phoenix, really, for us, balanced market's more like 2.5, 3. That's pretty balanced but brisk. Okay. So we're definitely higher in month supply. That means if no other homes came on the market, that's how long it's going to take to sell all the properties. Okay. Our absorption rate is down. Okay. This number should be much higher. Average list price 790. Average sales price 594. That's down just a little bit. The average sales list to sales price ratio is 97.66. We like to be closer to about 98. 98 is a little bit healthier, a little over 98. And then you can look at the breakdown in price ranges and the units, days on market. Look at how long some of these days on markets are taking here when you break it up. Under, 600,000 is 65 days. Okay. So it's just, it's just been a shift in the market again. We had lower rates at the end of last year, beginning of this year. Okay. When rates, the average across the country national rate was like 6.6, right in that area. And then they went and spent more money. They went and printed more money and put y'all in the poorhouse. So that's just our government for you. But both sides. The Crawford Market Index, if you were to go back and look at the contract ratios, we're seeing that there are a few hot spots like Chandler, Levine, Tolleson, some areas in Tempe, but for the most part, everything is in balance or kind of cold. Okay, beyond that. Um, but if you look at also the index through time and look at where we're at right now and go back even to 2014, that was really the last time we saw numbers like this. And at that point, we were at 83.5 on the demand, sorry, on the supply index. So um, it really, you know, that's as long as it's been since we've kind of been spoiled, basically. And that was for a very short period of time. Um, it was about a year, pretty close to a year where we're in that balance range at that point. But as far as the cities proper are concerned, Chandler, right now the overall sellers market index is down 3.4% away from a seller's market. Okay. Um, And we see that Chandler's still in a seller's market at 203 on the index. Remember, over 110 is a seller's market. Chandler tops the charts at 203, but it's down 5%. Fountain Hills at 181, Avondale at 155, 152, Tempe at 151, Mesa 145, Gilbert 144, Glendale 143, Phoenix proper is at 139, Scottsdale 123, Paradise Valley 119, and Peoria at 113. Those are all sellers markets. Okay. Those are all in a seller's market. If we look at, let's see, Goodyear is in a is at 94. Okay, so technically that would be in a balanced market. Cave Creek is at 91 balance, and then Surprise, Queen Creek, Maricopa City, and Buckeye are all in buyers markets. Okay. So, guys, if you have any other questions about your area in particular, what's going on in the market with your area, it's going to be super important to make sure that you're able to properly market your property. You want to make sure it's priced accordingly, but also offer those concessions and have those discussions up front with your real estate agent, because those are things that people are just going to be looking for right now. If you overprice a property and it gets stale on the market, people start wondering, what's wrong with that? What, this and that. A lot of people today, they especially with as expensive as everything is, unless they're used to doing investments, they really don't want to do a ton of improvements. Um, or they're going to want an incredible deal in order to do those improvements. So if your home is not up to date, there's certain things you can do, but you don't want to overdo it. So that's why, always, 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 please, no matter what you may think is going on or what's happening, consult with a really good, experienced agent that can really guide you through if any updates need to be made. Um, and how your home would present in today's market versus the price, right? Because that's it. How does it present versus the price? It's really going to come down to the price today, offering some, being able to offer concessions, price, and the condition of your home. A lot of people just, with expensive as everything is, they're going to be very picky. Just think about it. If you're out there looking for a property, do you want to pay top dollar plus pay high interest rate? Maybe even if you get a buy down, do you want to deal with a bunch of improvements right now? Obviously, there's going to be some things that you're going to do to any property that you buy. Even a brand new home, you may put accent walls, landscaping, pool, whatever, but you don't necessarily want to get into maybe like a kitchen or bathroom remodel, okay, or something like that. So anyways, guys, if you have any questions at all, feel free to reach out to me. I'd love to be able to help you out in any way I can.